Hi everyone, in this video I'm going to talk about how does the shareholder loan account work. So this is pretty common. I get a lot of questions. So shareholder loans, this is going to be related to corporations. Now mostly I work with Canadian corporations, so I'm going to be talking in that aspect. Mostly e-commerce, Amazon sellers, so a lot of it's going to be skewed that way, but this is how the shareholder loan account works. Okay, so first, what is a shareholder loan account? So shareholder loan is money that you loan to the company. You got to remember, a corporation is its own standalone entity. It's its own self. So it has revenues and expenses and liabilities and accounts receivable and all that type of jazz. So when you first start it, there's nothing there. I mean, you've just created an organization. Then you got to set up a bank accounts, credit cards, and then you got to like put money into it. So usually what people will do is okay, so when you first set up your company, you've got shares. So most people will say, okay, look, we'll put in 100 common shares. I mean, that's when you're establishing your company. You say, great, there's going to be 100 common shares, and those common shares represent the ownership of the company, and they're going to cost $1 each. So you put in $100, and now you own those shares. So that $100 is basically like locked into the company now. That's your contribution. Then after that, of course, you got to buy inventory and you got to do stuff. So usually what you do then is I suggest people set up a shareholder loan account, which is just another, account in your QuickBooks chart of accounts kind of thing. And that is where money that you put into the company that you're lending it, that's how we keep track of it. So when you think of like debits and credits, you've got the cash going into the company. So you put $5,000 in, and now that company has $5,000 cash, which is an asset, and then it's got $5,000 in a shareholder loan back to you. So as the company then has profits and there's cash available there, it can eventually repay that shareholder loan. So shareholder loan is no different than if it was a loan from the bank or somebody else or an account payable. It's a liability to the company. Okay, so as you start to put additional funds in or take money out, we do it through that shareholder loan account. So usually what happens, you start and you're like, great, I'll put $5,000 in and I'm buying some products, and then maybe you need to put another couple $1,000s in, and you put that in, into the bank account, the corporate bank account, and then you offset it in the shareholder loan. But then as you start to go on, maybe you take some money back out, take it out against the shareholder loan, and that'll bring the amounts down. So let me just show you a little visual here. So this is just a sample balance sheet, okay, of a corporation. You've got cash, accounts receivable. Accounts receivable usually are like, Amazon amounts outstanding. We got some inventory. So down here in the liabilities, so this is where you see the shareholder loan. So in this company, for instance, they did the classic, okay, 100 common shares for $1. And then the shareholders put in another $126,000. So this company here owes $140,000, $126,000 to the shareholder, some income taxes payable, credit card liabilities, whatnot. But this is all amounts that are owed to different people. And this one is a shareholder loan account. So if all of a sudden the shareholder said, look, I'm going to take out $45,000 and the cash is going to go down, you can then just decrease this loan by $45,000, right, as you're taking it out. Okay, so funds you put in to this company come from savings, personal lines of credit, whatever. Those funds that you put in are for money that you already pay tax on. Let's say you had a job and you're earning salary and you're paying tax on that, and you've got a little bit of savings. You had like $5,000 or $10,000. You've already paid tax. That's after tax earnings that you have. So then you're going to loan that to the company. Okay, put that in as a shareholder loan. Then, as there's money available there, you can start to take that out. And when you take that loan back, you take that back tax-free because you used your after-tax money from your job or savings and put that into the company, so then you can take that back out. Okay? There's basically three ways you get money out of your company. One, repayment of the shareholder loan, and then either through a salary or through dividends. We're going to talk about that in a minute. So the shareholder loan is just another payable, back to you. There's no obligation to, when the company needs to repay you, because I mean, it's your company, you're the shareholder, you're the one that's put the funds in. Okay. So another thing too is when people incur expenses, let's say they pay for them out of pocket, but they're related to the company. So common ones like, some people are doing, paying a portion of their cell phone bill or internet expense, let's say. And they'll pay for it out of their own pocket, but part of it is business expense. Then you record the expense in the company, So you're debiting the expense, and then the credit, the offset goes to the shareholder loan. Same thing like if you went out and say you had to buy a bunch of boxes for your company and you didn't put it on a company credit card, you didn't pay it out of the company bank account, you just paid for it out yourself, but it's a business expense, then you would record the expense in the company and then the reimbursement, the offset to the shareholder loan. So part of what we do at year end is, okay, any other expenses that you paid for out of the business that should be for the business out of your own personal pocket can be put in there. Another common one we do is the kilometers, right? Like if you're invoicing, charging the company kilometers, then you would put it against the shareholder loan, and then as there's actual cash to come out, you take it out. Okay. The repayment comes back to you tax free, as I said, but I mean, there obviously has to be cash in the company to take it out, right? So what happens when you take out more than you put in? Because this is usually what I see. So people that are, okay, I'm putting money into the company, I'm putting money in, it's doing well, now it's generating some profits, start taking it out back against that shareholder loan. And then when it gets to zero or a negative where you've taken out more money than you've actually put in, that's when we need to clear it up. So three ways to get money out of the company, right? Repayment of the shareholder loan, then either salary or a dividend. So once you've taken out more, by the time you get to your year end, this is when you don't want to be in the position where you've taken out more than you put in, because then it's really an account receivable. You owe the company money. And what CRA doesn't like is they say, look, basically the company loaned you money that you should have taken as a salary or a dividend. Well, that's really a benefit to you, and that should be a taxable benefit. So, we're going to charge you interest on that, and that should have been included on income, and we'll take interest and penalties. Like, it's a mess. So we always want to make sure, that, I mean, there is some rules that you can do it and carry it over, but I don't want to do it. I've seen people get burned by it. I hate it. So I just make sure that, no, this is how we're going to do it. You always make sure that, we get that back to zero. So I just do it slightly over. So there's, usually a couple $100 in shareholder loan outstanding. Okay. So to get it back to zero, you would issue a dividend. That's another common practice. So the end of the year, the end of the calendar year, December 31st, you say, okay, have you taken out more than you put in? Yes, I took out an extra $10,000. Well, we make an entry to pay out a dividend of $10,000. You issue a T5 slip, and that's submitted on your personal taxes and uploaded to CRA. That gets it back to zero. The other thing is you could take a salary for whatever is outstanding. So if it was $10,000, you could take a salary instead and then pay it and send the remittances to CRA, and then that would get you back to zero. Okay. So lots of clients take money out, put it in, back and forth. It's not ideal, but it happens, right? So that's why we do either issuing a dividend, and the dividend. So if your corporate year end is like a different than the calendar, like your personal taxes are always going to be January to December. So if you've got like a year end that's in the middle, then you've got to kind of do almost two dividends, right? Like, okay, the company year end, as of that time, what is the shareholder situation? And then at the year end, the December 31st, what's a shareholder situation? So you might in fact have two different T5s or two amounts calculated, to account for that, because your personal taxes are always going to be December 31st. And then to issue the T5 slip, it has to be done by the end of February, or else you'll get interest and penalties and a bunch of other crap. Can't be late, and they're jerks about it, so you want to make sure you get it in on time. So that's why you also need to have your bookkeeping up to date. Okay. The salary, you've got to pay it out, and you've got to send the remittance and the withholdings to CRA. Another common thing people ask is, okay, what's the difference between the salary and dividends? So first one, repay the shareholder loan, money comes back to you. Once that flips to the negative, then we got to decide, okay, are we doing the salary or the dividend? The salary is an expense to the company, so there's no corporate taxes paid. Like when you think about the income statement, revenues, expenses, then there's the profit, then we have corporate tax based on that profit. So in this case, if you pay yourself a salary, it's just more additional expenses, so it lowers the profit to the company. And usually a strategy we do is if your company profits over 500K, which is what the small business deduction amount and the lower tax rate is for corporations in Canada, then we'll pay a salary to bring it down. Okay. Dividends, on the other hand, are paid from the profits after the corporate taxes. So you've got the revenue, expenses, here's the corporate profit, then we pay some corporate taxes. Okay. And then the money left over is what the dividends really are distributions. So salary is taxed basically, let's just, like at the highest amount. If you pay out the dividends, your personal tax is a little bit better on dividends because you've already paid some corporate taxes. So that's how it evens out, right? Even if you just say, like, let's just take a round number for, 15%. Like if your salary, if you paid 30%, tax rate, personal tax rate, and your dividends might be 15% because the corporate taxes would be 15% and then the dividends would be 15, so it all evens out. There's no sneaky way like if you do one or the other you're going to save a bunch. There is some differences between the salary and dividends and reasons why you might want to do one or another, but that's the gist of it. Okay, so as you're going through, you got to make sure at the end of your corporate year end, whatever that timing is, what's the state of my shareholder loan, and then also what's the state of my shareholder loan at December 31st, because those are the two key dates, to make sure that, okay, we're on side with, do I need to declare dividends to get my shareholder loan back on side and issue the T5 and make sure that's done on time. So that's why you also want to be really on top of your bookkeeping, especially at the end of the year. It's a tight turnaround January, February, because you need to know what that shareholder loan balance is and whether or not you need to issue that T5 slip and get it in. Because if you're late, it's like $600 or something plus, like penalty. Like, it's a good chunk of change if you're late filing it and getting it in. So I always recommend stay on top of the bookkeeping, get it done, get it in. So hopefully that gives a little more clarity on shareholder loans and was beneficial for everyone.